Thanks, Chris. The lawyer at the end of the day. So you all are pretty brave to have stuck it out, so I'll do what I can to make it move reasonably quickly and hopefully in a modestly interesting way. All right, me. So I'm one of those rare persons who's actually made a legal career out of serving the merchant acquiring industry. There's not many of us. Wasn't by design. I come out of law school, wanted to be a deal lawyer, professionally from Atlanta. Atlanta, as people will know, is a hotbed of innovation, NDC, and a bunch of the all sort of spin-offs where people said, this is a place where you can make some money. And if people want to sell businesses, grow businesses, buy businesses so that they can grow their business. Jeff talked about the buy and build. You need lawyers. And so that's where we came in. And that's sort of how I sort of fell into it. And I've been doing that now for nearly 25 years. I am, as you can hear, I'm an American. Been in Brussels now for 14 years, basically doing almost, not exclusively acquiring, payments generally, but fundamentally I'm just an M&A lawyer. I buy and sell businesses for clients, and that's all I typically do. We do regulatory, I do regulatory, but I'm more transactional than regulatory. If you have regulatory queries, Gerard, Chris, Luke, he can sort you out on MIF, PSD2, and the like. As a firm, you've probably not heard of us. We're about 800 lawyers. Only a handful, though, in Brussels and Beijing. And there's over 20 of us that are like me that basically do this type of work. So that's me. So just quickly about you all. So have to have a show of hands type query. So how many are actually either in the business where their job description or because they were the founders involves maybe selling or buying payments businesses? And I recognize that there'll be a lot of product and marketing folks in here, and folks who actually buy and sell will probably, okay. Well, people deal with lawyers though, right? So probably more actually deal with lawyers. All right, so let's talk about sort of some of the things how we sort of lay out the selling process, and when we have companies that are looking to build a business or a payments business, or they spin out of a larger business and they want to build and grow their own, what do we talk about? Well, we tell them a few things. One, you're sort of keeping the house clean from the outset. You're thinking about that from day one. Early on, there's going to be a potential decision about how you organize the entity. And so that's going to vary jurisdiction by jurisdiction. If you're in the US, the UK, Ireland, what have you, it's going to differ. Typically, though, it's a pretty straightforward decision. It's going to be guided by tax. It's going to be guided by liability. It's going to also be, if you're thoughtful about it, in terms of your divestiture. And certain ways in which you organize are a little easier than others, a little more sensible, and tax drives a good part of it. We also advise folks to take care of minority investors, whether at the outset or throughout the process. Now, let's be clear, owning 60% of a successful business is a lot better than owning 100% of a failed one. So there is a limitation to that type of guidance. This next bullet about planning across, being thoughtful across all your contracts from day one is an important one. Because ultimately this business is very much contractually driven. And when lawyers like me come in to figure out, all right, is this a business that holds up to the valuation? Is this a business we're interested in buying? We look at the contracts. And there are things in there that can be problematic. So you want to be thoughtful about your terms and conditions, your referral agreements, sponsor bank relationships. Those are obviously pretty critical. We'll talk about that from a buyer side. Free assignability, the ability, this collection of contracts, this collection of value, this collection of customers, the ability to then sell it onwards, because that's what you want to do. If you want to build this company, you want to sell it onwards. One of the things we also look at is just making clear, regardless of the relationships, the referral relationships you may have, the sponsor bank relationships you may have, that the ownership of the assets. And typically, if it's an ISO, for example, it's the customers, your merchant agreements, but there's other things. There's technology, how you interface with your customers. You want to know that you've got unambiguous ownership, and that you, in turn, can actually sell it onward. That's the point. Sponsor bank relationships we talked about. Exclusivity and quasi-exclusivity, also something that can be challenging. There's good exclusivity when you get a big customer and you're the only referral source or referral destination for that provider. But otherwise, those things can provide challenges and encumbrance, if you will, going forward when people are looking to consider buying your business. Process, if you're in this. So again, similar, it's no different. Buying and selling business is really not much different than putting your house on the market. You want to prepare in advance. You don't put it up slapdash. You want to make sure the place is clean. Selling a house, typically you get a broker. Here, depending on scale, there's people out there. PSE will help you. There's other advisors. There's investment banks, depending on the size of the enterprise. I'm sure that our friends at Payzone are getting calls all the time from all sorts of people and banks that wish to work with them. And of course, you're going to need lawyers ultimately. But in the first instance, you're interested in figuring out, all right, what's the value of my enterprise? How can I drive it further? What is the market? Now, and indeed for some time, it's been pretty frothy, which is good for people like you who are in the business, who've got equity in businesses. You like to see those things. It's good for those of us who serve businesses, PSE, investment banks, lawyers. Tax planning is also and always pretty critical. And then part of it is also just reviewing the contracts, the business, to make sure that you're looking at it from the perspective of a buyer to take care of the sorts of issues that may concern them, whether it's the ownership of IP, whether it's customer retention issues, whether it's litigation and problems. Trying to be upfront about that and handling that early is always a good thing. And then you get into the actual metaphysics of actually collecting your data, your contracts, your vendor agreements, your terms and conditions, the stock of data room, so that folks can go in there, look at it, and figure out, do we want to buy this business? Does it hold up to the valuation? Last point here about cyber compliance. Obviously, if we were having this conversation 5-7 years ago, not as big a deal. Now it's a much bigger deal. It's a huge deal. It is heartbreaking if you're in the midst of a selling process and you have a breach. That sort of thing is not good. Or even worse, you're in the midst of the selling process and you realize you had a breach well before it began. You just found out about it now. While it's good advice always, certainly in the context of looking to sell your business, it's particularly important. On the compliance side, depending on the pool of folks who might be interested in buying your business, again, particularly important now with financial institutions. They'll put more of a premium on it than, say, a private equity house. But it is something to consider and be thoughtful and prepared for. All right, buying. Buying, again, it's the flip side of this stuff, and so I won't spend too much time talking about this. But this is the flip side of whether or not your seller is thoughtfully prepared. So you're in there, you're doing the diligence, you're trying to figure out everything in terms of the contracts, HR, IP, quality of the relationships, ownership. Again, with technology and so many cross-referral relationships, that can often be a legitimate issue, like who actually owns the customer relationship. Can we take the relationship, or can my partner take it from me? Certainly, again, on the sponsor bank, for those of us who need to work with sponsor banks, an important issue to make sure that when we're in there looking, we want to make sure it's clear that the sponsor bank is just there to facilitate, but that the ownership of the underlying asset, the portfolio, is with the counterparty, and that the ability to swap out that sponsor bank, that's an important thing for any buyer. Regulatory, also, again, one of these things of increasing importance. You have to worry about it in terms of the regime, depending on what's happening, the jurisdiction you're involved in. That's a moving target. It's a moving target here in the EU to a certain extent, a moving target with Brexit. And when you're going cross-border in other jurisdictions, one of the gentlemen earlier spoke about Brazil, challenging regulatory environment. We help bring some folks in there. You go in there, it's unregulated, acquiring the way here 10, 12 years ago, actually 10, acquiring wasn't regulated in the EU. You go into a place like Brazil where the duopoly had just fallen, and you understand that there is the risk, because acquiring regulation is growing around the world, there is the risk that it could become regulated. And indeed, not long after we brought these folks in, new payments regulation, new capital requirements, these are the sorts of things as a buyer you worry about. We spoke about compliance, AML, KYC, again, particularly if you're with a financial institution or quasi-financial institution. Credit loss and chargeback risk, something that in the past had been sort of overlooked, but headlines like Monarch, I think folks are pretty much dialed in to that concern these days in terms of the types of exposure. It could be monumental type loss that you're buying if you're in that situation. We also talk about hanging on to sales reps and management. We talk about integration and implementation to make sure that when you're doing it, you see a way forward. Again, not just because you're a recent speaker there, the pay zone. Jim, if we're buying pay zone, if it's ever up for sale, then we're interested in making sure people stick around and that we've got the management there. And management's going to take a little money off the table. So you want to make sure, all right, these folks invested. They're going to sit around and stay there to help us run the business. Do we got them locked down with non-competes to make sure they're not going off and replicating this next X million, X billion dollar business? Concentration risk, also something we look at in terms of cross customers, cross key sales reps, and the like. All right. JV strategic alliances. These are actually more interesting for us, often for you as well, because these are more complicated. Going in and buying something is relative, it's transactional. JV strategic alliances need to live. And you've got a partner, and you don't always control it. So Jeff from Evo was talking about how they go in and are reliant on bank alliance partners to go into the market, and that's something. They go in there, they're likely buying an asset, buying a portfolio or an interest in the portfolio, and then they're working with their bank partner to run this business in country. And that's hard. You have to memorialize that. You have to figure out how you're going to control who gets say over what. And of course, you also have to contemplate what happens in the unlikely, but ultimately these are fixed term deals, 5, 7, 10 years. What happens when we break up? So you do the prenup ahead of time. Interesting transactions, hard transactions, but fun for all of us and a little aggravating, I think, for our clients. All right, let me pause there. I'll get a spot of water. Any quick questions before I move on? So this is sort of old school. This morning, and I'll get to that question in a moment. This morning there's a dichotomy between sort of old school acquiring and card-centric, and I'm old school. I'm one of those card-centric guys. And I'll talk a bit about new school, disruptors, fintech, in a bit. But yes.
Okay, so I work for Elevon, and so JVs and strategic alliances is very much the way they grew outside of the US.
Yes.
But actually our experience is you may have a majority share, you can't control your banking partner in market. And most of the time, with the management share that you tend to get across both companies, what started as a close relationship 5 years, 7 years, 10 years down the line, actually you do turn back to the contract to run the organisation rather than, even if the people on the ground are making it work, it's often new egos come in, new management is moving around, and often the vision for the JV is very rarely ever achieved. So have you ever known of any that have been actually brilliantly executed where the vision is maintained?
Well, brilliantly executed is a high standard. And as a matter of full disclosure, I'm familiar with those JVs. And I've seen the life cycle of things. And I've seen organizations that say, all right, we're going to do JVs. And I've seen this again. I've been doing this long enough. In the late 90s, there's organizations, you do a few JVs, and you say, this is pretty great. We get this great partner, and shared expense, and de-risking, and, and things go south, and you realize, you know what? When you don't get to make every decision, and you have to rely on your partner, and sometimes because management turns over, yours, theirs, folks will go through waves, and you'll see them do 4, 5, 6, and then stop doing proper JVs. And then the institutional memory ceases, and you go, so for example, Alvana, it might be a while before y'all do another another JV, proper JV, because they are hard, you know, and so it is, yeah. So fortunately for us, all we do is try to, as the lawyers, document it, and we try to get it done properly, document it sensibly. But ultimately, the docs, you know, we always say as deal lawyers, we want the docs, you sign them up, you work very hard on them, hopefully they go in a drawer, and you don't pull them out. You run your business. Sort of wishful thinking, but yeah, that's an astute comment, I guess, born of personal experience, so there you have it. All right, moving on. So I'll transition quickly into sort of fintech and new school and disruptive economies. I guess we're here and want to have to talk a bit about Brexit and how this is impacting sort of the payments business. And I think it's I guess, two points that all that really matters are just the uncertainty. So it chills activity. So there's certainly a chilling of activity from our perspective of folks who buy, and certainly on the buy side of UK. But there's still plenty of reasons to do it. If your customers of that business are here in the UK, you don't really care about Brexit, because if that's the market, that's all that matters. If, in contrast, this is meant to be your entree to the rest of Europe, or it's a truly pan-European business, or you're trying to start a payment institution and trying to figure out where you want to be, while prior to Brexit, UK would have been on the top of the list. Enlightened regulator, for us and our clients, English matters. Now you can't say that, because you have to sort of wait to figure out what's going to happen in terms of your ability to move your goods, your services, without having to be licensed across, at least in another jurisdiction, to gain access to the EU. All right. So this morning, again, many of the speakers talked about this. I'll speak a bit about how this is impacting kind of what we do, M&A, investment activity, and it is having an impact. I mean, so we will have banks, staid, incumbent banks, who never would think about investing in these types of enterprises, these startups that do it. And so this is an interesting part of what lawyers like me are increasingly involved in. This is a slide I borrowed from someone at Citi. I also think that I know regulation is, and we all have our views on it, but certainly as an accelerant to people thinking there's an opportunity, it has served that. I mean, the notion of sort of a pre-SEPA, where you've got national markets, everyone's got their own little system, and you can provide acquiring or other payment solutions in country, but the ability to grow across borders was challenged, and the market just wasn't large enough to support larger solutions or more scaled solutions. Now, clearly, we're not here. We're not at complete frictionless payments across all of Europe, but as a accelerant to causing people to get into the market to try to figure out, all right, there's a way to do this. Regulation has helped. Obviously, more than anything, it's technology. It's how we've talked this morning about the subscription economy and the other means in which to affect payments. And cards are old school, and we've got more interesting ways. And we also talk about how we've got millennials, these young kids who don't wear watches and don't ever worry about giving out their information. And here's another example, and Gerard had earlier shared this with me. Back when we were doing this years ago, 10, 12 years ago, terminal estate wasn't a big deal. It was, at the time, Hypercom, Verifone, and Genico maybe 3 models each. I mean, it wasn't really anything to worry about or think about. Obviously now, it's a completely different environment. And for us as the legal servers who it drives activity where folks want to invest or need to take on different innovative solutions, sometimes several, because they're putting a bunch of chips on the roulette table to figure out which one's going to carry the day. Another element that's, again, we do a lot with banks. This is slightly dated, 3 years old, Fast Company article, but this is something that we see this dynamic where the generation that otherwise would be called millennials is influencing tremendously what happens in the payments market everywhere. I mean, so it's not, obviously it's not just payments, but banks are beginning to feel this about how there is a generation that doesn't need the bank anymore. They're more confident and comfortable with their phones and with the large tech providers. Indeed, we're speaking tomorrow with a big top 10 US bank precisely about this dynamic, about the regulatory impediments for the Googles and the Amazons to actually get in there and take proper banking away from banks. But it's a real issue, and it's something that, again, happily for those of us who are there serving, drives activity, drives investment, and at times interesting. A few, again, from 2014, some interesting nuggets. I think this will be available afterward as part of the materials that PSE provides. Let's see, what else do we got? All right. So here in the EU, I mean, we get asked these questions because we'll often get American companies, for example, as an American headquartered firm, that, and they're interested in entering the market. You know, payments is terrific because it's in fact global, and the ability to grow is there, and people like growing businesses. So we get the question about the EU going crazy with regulation. Obviously, there's been a good bit of it. Some of it, as Luke well laid out, has had the intended effect. We can argue with whether the intended effect was worthwhile or not. Others has fallen short. I think people, particularly if we're dealing with the brands, the schemes, saying, you know, what's the EU got against? I mean, we got this infrastructure. We're Visa, we spend lots of money. We've made life good for lots of people. And yeah, everyone's entitled to make money. Why does the EU, what do they have against cards? So we get some of that. And the dynamic I talked about, just a demographic one about the millennials sort of changing real time how financial services will be offered and consumed. And, you know, I guess here just kind of how I answer it. I said it on the EU side, that clearly from the green paper onward, but indeed before that as part of the original PSD in 2007, is that the EU very much wants to be at the forefront of the payments market and thinks they can regulate their way to a better, more just, more efficient, more consumer-friendly market. Again, results yet to be seen in full. I think some of that has been borne out, but again, as Luke is, at least on the MIF side, it perhaps hasn't, it's still early, but hasn't done what it's meant to do. Bashing on MasterCard and Visa, so that's just one of those things. I guess with market power, when you're at the top, you're always getting hammered. But the gentleman this morning said perhaps time at the top is, the end is nigh for those dominant brands. And in terms of the effort from the EU, at least to create a more level playing field, and who knows what happens once Brexit is complete and you have the FCA figuring out, presumably they'll be somewhat similar to what we've got in the EU, but a level playing field is good for fintech. It's good for the little guys, the innovators. So that's a great thing for transactional activity, for growing payments companies, and the like. And there you have it. So that's, thank you for your attention. Chris?
Thank you. Thank you.